Okay, so you want to own a hotel chain. Not one hotel, a chain. Your name on buildings in 40 countries, a helicopter view of some resort in the Maldives, room service bringing you a drink while somebody else worries about the sheets. That's the dream. Here's what actually happens. First question, how do you even get into this business? There are basically two doors. Door number one, you build, you buy land, you hire architects, you pour concrete, and 18 months to 3 years later, if nothing goes wrong, you open a hotel. Door number two, you buy an existing brand or you franchise one. Most people who tell you they own a hotel chain don't actually own the buildings at all. They own the brand, the reservation system, and a contract that lets somebody else's money build the actual building. That's the secret nobody puts in the brochure. Marriott, one of the biggest hotel companies on the planet, owns less than 1% of the roughly 9,000 hotels flying its flags, less than 1%. The rest belong to investors, developers, pension funds, guys who took out a loan and slapped a Marriott sign on it, because the brand brings guests through the door. Same story at Hilton, same story at Intercontinental Hotels Group. The names you recognize on the highway sign are almost never the names carrying the mortgage. So if you want in cheap, you become a franchisee. The entry ticket for a mid-size branded hotel, something like a Hampton Inn or a Holiday Inn Express with 80 to 100 rooms, runs somewhere around $8 million to $15 million, depending on location and land costs. That includes land, construction, furniture, and the franchise fee itself, which alone can run several $100,000 just to use the name. On top of that, you sign a franchise agreement that usually locks you in for 15 to 20 years, with royalty fees running around 5 to 6% of room revenue, plus another few percent for marketing and the reservation system. You don't just pay once, you pay forever. Every single month, whether you're full or empty. If you want to build a full-service 4-star property with a pool, a spa, and a ballroom for weddings, multiply that by 3 or 4. A proper big city flagship hotel, 250 rooms, restaurants, conference space can run past $100 million before you've sold a single night's stay. And if you're picturing something truly iconic, a beachfront resort, a downtown skyscraper hotel, you can throw all these numbers out and go much higher. Land alone in a prime tourist district can cost more than the entire construction budget of a suburban hotel. And that's just to open the doors. Here's where it gets uncomfortable. Owning one hotel is a business. Owning a chain means you're now running dozens, sometimes hundreds of these businesses at once, each with its own staff, its own maintenance headaches, its own local competition, its own city council and zoning board to deal with. It stops being hospitality and starts being logistics at a massive scale. You're no longer just hosting guests. You're managing a small army of general managers scattered across time zones, each one making decisions that can make or break the property's reputation on a review site before you even hear about it. There's also a quieter path in, one most people never think about. You don't build anything at all. You just buy an existing hotel that's already operating, already has staff, already has a track record. This sounds safer, and sometimes it is, but you inherit everything the previous owner left behind. Deferred maintenance, an aging roof, outdated wiring, a reputation that might be great or might be quietly declining. Due diligence on an existing hotel purchase can take months, and buyers routinely discover 6-figure repair bills hiding behind a fresh coat of paint in the lobby. Let's talk about the real cost of building and running these things, because the sticker price is only the beginning. Take Las Vegas, the ultimate hotel town. The Cosmopolitan, a single resort on the Strip, cost roughly $4 billion to build back in the early 2010s, and it went through bankruptcy proceedings during construction before it ever opened a single room. The Wynn Las Vegas cost around $2.7 billion. These aren't outliers because Vegas is special. These are outliers because hotels at scale are enormously expensive, and construction almost never finishes on budget. Cost overruns of 20 to 30% above the original estimate are considered normal in this industry. Not surprising. Part of the reason is that hotels aren't simple boxes. Every hotel is effectively a hybrid building. Part apartment complex for the guest rooms, part restaurant, part event venue, part gym and spa, part parking garage, sometimes part retail. Each of those pieces has its own contractors, its own permits, its own building codes to satisfy, and any delay in one piece, a kitchen ventilation inspection, a pool safety certification, an elevator installation backlog, can hold up the opening of the entire property, while the interest meter keeps running on the construction loan. And it's not just Vegas. The Marina Bay Sands in Singapore, with its famous rooftop infinity pool, cost around $5.5 billion to build, and that was back in 2010. Adjust that for construction inflation, and you're looking at a project that would cost far more today. Even a modest business-class hotel in a major Western city, nothing flashy, just a clean 200-room tower near an airport, routinely runs $60 to $80 million. Once you count land acquisition, permitting delays, and the inevitable change orders that pop up mid-construction when the contractor discovers the soil isn't what the survey said it was. Now here's hidden trap number 1, and this is the one that kills people who think hotels are easy money. The expenses start long before the revenue does. You take out a construction loan and the interest on that loan starts accruing the day you break ground, not the day guests start checking in. If your project takes 3 years to build, you've paid 3 years of interest before a single dollar of room revenue has come in the door. Meanwhile, once the hotel opens, you're deep into depreciation. Furniture wears out in 5 to 7 years. Carpets, curtains, mattresses, all of it needs replacing on a cycle, and hotel accounting has a specific line item for this, called FF&E reserve, furniture, fixtures, and equipment, and operators typically set aside 4 to 6% of gross revenue every single year just to keep replacing things guests wreck or wear down. You're not just running a hotel, you're running a business that eats its own furniture on a schedule forever. Then there's the labor problem. A full-service hotel needs housekeeping, front desk, maintenance, food and beverage staff, security, sometimes 24 hours a day, 7 days a week, 365 days a year. Labor typically eats up 30 to 40% of a hotel's total operating costs, and unlike a factory, you can't automate away a housekeeper who has to physically clean 16 rooms a shift. Wages have been climbing steadily across the industry for over a decade, and post-pandemic staffing shortages pushed many hotels to raise pay just to keep enough workers to open all their rooms. Some markets even saw hotels temporarily suspend daily housekeeping just to stay staffed at all, quietly shifting labor costs onto guests in the form of a worse experience rather than a higher room rate. Then there's insurance, and in certain markets this alone can sink a property. A beachfront hotel in a hurricane zone or a resort in a wildfire-prone region can see insurance premiums double or triple within a few years as insurers reassess climate risk. Property taxes climb too, often reassessed upward the moment a renovation makes the building more valuable on paper, which creates a strange incentive where improving your hotel can directly increase your annual costs before you've earned a dollar back from the upgrade. And then there's the franchise brand standards audit, an inspection that can force you to spend hundreds of thousands of dollars on a mandatory renovation cycle, new mattresses, new carpet, new lobby design, simply because corporate decided the brand needs a refresh, whether or not your particular property can currently afford it. So how does this thing actually make money? Because clearly it's not simple. There are 2 main income streams, and understanding the difference between them is the whole game. The obvious one is rooms. You rent out beds for the night. This is the most regulated, most competitive, most visible part of the business. Hotel room pricing is set through something called revenue management, essentially the same dynamic pricing airlines use, adjusting rates hour by hour based on demand, local events, and how full you already are. It's a real skill, and it matters. But the margins here are thin. Rooms are the commodity everyone competes on, and average occupancy across the industry hovers around 60 to 65% in a normal year, meaning roughly a third of your rooms sit empty on any given night, still costing you money in cleaning readiness, insurance, and depreciation, even with nobody in them. And rooms are also the part of the business most exposed to online travel agencies, the booking platforms that guests use to compare prices. Those platforms typically take a commission of 15 to 25% off the top of every booking made through them. So even when you fill a room, a chunk of that revenue never touches your bank account at all. It goes straight to a third party for the privilege of being found. This is precisely why hotel chains fight so hard to push guests toward booking direct through their own app. Because every booking that bypasses the middleman is pure margin the chain doesn't have to share. The less obvious income stream, the one that actually makes hotel chains rich, is everything that isn't the room. Food and beverage, banquets and weddings, conference space rental, parking, spa treatments, minibar markups that would make a convenience store blush. And increasingly, the biggest one of all, the loyalty program and the franchise fee structure itself. Marriott Bonvoy, Hilton Honors, these loyalty programs aren't just marketing gimmicks, they generate billions in co-branded credit card fees, paid by banks like Chase and American Express to be the exclusive card partner, money that flows straight to the hotel company with almost no operating cost attached at all. This is the part nobody sees. The credit card company pays Marriott for every point you earn, whether or not you ever redeem it. That's nearly pure profit, layered on top of the actual hospitality business. Think about how strange that actually is for a second. A bank pays a hotel company billions of dollars a year, and in exchange the hotel company hands out points that cost it almost nothing to issue, since a lot of those points get redeemed for rooms that would have sat empty anyway on a slow Tuesday night in a random secondary city. The marginal cost of letting a loyalty member sleep in an otherwise vacant room is close to zero, just some extra linens and electricity, while the cash the bank paid for that point is already booked as profit. This single mechanism, more than anything happening at the front desk, is why hotel company stocks trade at valuations that would make a normal real estate business blush. This is exactly why the big public hotel companies have spent the last 20 years selling off their actual real estate and becoming what's called asset light. They don't want to own buildings anymore. Buildings are expensive, they depreciate, they need capital expenditure, and a hurricane can wipe one off the map. What they want is the brand, the booking app, and the franchise agreement, which is closer to a royalty business than a hospitality business. It's the difference between owning a taco truck and owning the recipe that 10,000 taco trucks pay you to use. Now let's talk about what happens when this goes wrong, because it goes wrong constantly. Look at Revel Casino Hotel in Atlantic City. It cost $2.4 billion to build, opened in 2012, and filed for bankruptcy within a year. It filed for bankruptcy a second time about a year after that. In 2015, it was sold at auction for $82 million, a $2.4 billion building sold for less than 4 cents on the original dollar. The problem wasn't the rooms. The rooms were fine. The problem was a declining regional gambling market, brutal East Coast competition, and a debt load that assumed growth that never came. This is the trap of hotels tied to a single local economy or a single anchor tenant, whether that's a casino floor, a convention center, or one enormous employer in town. If that anchor weakens, your hundreds of millions in fixed assets are stuck exactly where they are. You cannot pick up a 400-room tower and move it to a better location. A quieter version of the same story played out with countless hotels built around the oil boom towns of the American shale regions in the 2010s. Developers rushed to build hundreds of rooms to house oil workers, betting the boom would keep going, only to watch occupancy collapse when oil prices crashed and crews packed up and left almost overnight. Buildings that were fully booked at premium rates 1 year were sitting nearly empty 18 months later, with no local demand left to replace the workers who had moved on. The lesson is the same every time. A hotel built entirely around one industry, one employer, or one temporary boom is a bet on that boom lasting exactly as long as your loan does. And loans rarely cooperate with booms on the same schedule. Compare that to a genuine success story, and Marriott itself is instructive here because of exactly the asset-light strategy we just talked about. Marriott's operating margins on its fee-based, franchise-heavy business regularly run above 30%, extraordinary for anything resembling hospitality, an industry famous for razor-thin returns. That 30% margin isn't coming from cleaning rooms. It's coming from the franchise fees, the loyalty program economics, and the credit card partnerships stacked on top of a hotel network that other people's capital actually built and maintains. Marriott effectively figured out how to be a technology and branding company wearing a hospitality company's clothes, and the market has rewarded that transformation with a valuation that dwarfs hotel companies still stuck owning their own real estate. Compare that to the real estate investment trusts that actually own the buildings Marriott's flags fly over. Those companies own the concrete, the plumbing, the roof, and they collect a much smaller, much more volatile slice of the pie exposed to every recession, every renovation cost, every insurance premium hike, while the branding company sits comfortably above it all, collecting its royalty check regardless of who owns the walls. If you take away one thing from this whole video, let it be this. In hotels, the money increasingly isn't in the building, it's in the name on the building. So what actually separates the winners from the losers in this business? Scale is one factor, but not in the way people assume. Scale doesn't just mean more hotels. It means enough hotels in a market to negotiate better rates with suppliers, to run a loyalty program dense enough that people actually change their travel plans to stay in network, and to spread corporate overhead. Marketing and technology costs across thousands of properties instead of one location is the second factor, and it's brutal in its simplicity. A hotel next to a major airport, a convention center, or a can't-miss tourist attraction has pricing power that a hotel in a mediocre suburban location will never have, no matter how nice the lobby is. You could build the exact same building, spend the exact same amount on marble floors and rainfall shower heads, and the version 3 miles from the airport will out-earn the version 15 miles away by a wide margin. Every single year, forever, simply because of dirt and distance. And third, and this is the one that bankrupts people, is diversification of demand. A hotel dependent on one type of traveler, business conferences, one single airline's crew layovers, one casino's foot traffic, is one bad year away from empty hallways. The hotels that survive downturns are the ones pulling guests from leisure travelers, business travelers, event bookings, and long-term stays simultaneously, so that if one segment collapses, the others carry the building. There's a fourth factor too, one that's easy to overlook. Management quality at the individual property level. Two identical buildings with the same brand, the same location, even the same construction cost, can produce wildly different profits depending on who's running day-to-day operations. A sharp general manager who staffs correctly for actual demand, negotiates good supplier contracts, and keeps online reviews strong through consistent service can turn a mediocre location into a solid earner. A poor one can bleed money out of a great location through overstaffing on slow nights, understaffing on busy ones, and a slow drip of bad reviews that quietly erodes the booking rate for years before ownership even notices the pattern. Where is this industry heading? A few clear trends. First, consolidation continues. The pandemic wiped out a huge number of small independent hotels that couldn't survive, 18 months of near zero occupancy, and many of those properties got absorbed into bigger chains at fire sale prices, accelerating the asset-light, franchise everything model even further. Second, the line between hotel and apartment is blurring, with extended stay and branded residences, essentially condos with hotel-style services attached, becoming a fast-growing category because they combine steady long-term rental income with the higher margins of a hospitality brand. Third, and this is the one industry insiders talk about constantly, hotel companies are increasingly becoming data and advertising businesses in disguise, selling targeted placement and offers to their loyalty program members the same way an airline sells seat upgrades, another layer of nearly pure margin revenue stacked on top of the room itself. Fourth, technology is quietly eating labor costs at the margins. Mobile check-in, keyless room entry through a phone app, chatbots handling routine guest questions, all designed to shrink the front desk staff a property needs without shrinking the guest experience too noticeably. And fifth, remote work has permanently reshaped demand patterns, with business travel never fully returning to pre-pandemic levels in many markets, forcing chains to lean harder into leisure travel, weekend getaways, and the bleisure traveler who stretches a business trip into a mini vacation just to keep occupancy numbers where they used to be. So here's the honest math on owning a hotel chain. Optimistic scenario, you franchise a well-located, well-run mid-scale property. You hit 65 to 70% occupancy consistently. You layer in solid food and beverage and event revenue. And after debt service, you're clearing a net operating margin in the healthy double digits. Something like 12 to 18% of revenue, which on a $15 million property might mean genuinely comfortable six-figure annual profit once the loan is paid down. Realistic scenario, and this is the one that hits most operators. Occupancy runs closer to 55 to 60% thanks to a new competitor down the road or a slow year in the local economy. Labor costs keep climbing, that FF&E reserve keeps draining cash every single year for new mattresses and carpets, and you spend a decade mostly servicing debt and hoping for a good conference season. Watching thin margins get thinner every time a union contract comes up for renewal, or a highway exit gets rerouted somewhere else. In this scenario, you're not losing money exactly, but you're also not getting rich. You're the guy funding somebody else's loyalty points program while carrying almost all of the physical risk, the roof leaks, the recession, the competitor down the street, and getting a comparatively thin slice of the profit for taking on that risk. There's also a third scenario worth naming, honestly, because it happens more often than the success stories suggest. Outright failure. A downturn hits right after you've taken on debt. A bigger, newer competitor opens 2 blocks away with a flashier lobby and a better rewards program, or the one convention center that anchored your business relocates to a different part of town. Occupancy craters, you can't cover debt service, and the property either gets sold at a steep discount to someone willing to take the risk at a lower price, or the lender takes it back entirely. This isn't a rare tail risk in hotels. It's a recurring, well-documented pattern that shows up in every economic cycle, which is exactly why so much of the smart money in this industry has moved toward owning the brand instead of the building. You're not buying beds. You're buying a bet on foot traffic, on a brand's reputation, and on whether people keep traveling in numbers big enough to fill rooms you can't shrink when times get lean. You're not buying a hotel. You're buying a piece of somebody else's travel plans 40 years at a time.